After studying this module, you shall be able to understand the concept of primary market, analyze the different pricing method of initial public offering, and lastly understand the concept of IPO grading. The economic environment of any country depends on its strength of capital market. It helps in channelization of funds from the surplus sector to deficit sector and thereby helps in the process of capital formation. Capital market is the market for long-term securities. Its objective is to meet the long-term requirement of the industry. Indian capital market is going through a phase of economic transition. The structural reforms in the form of de-licensing, rupee convertibility, tapping of foreign funds, easier norms for FDI and allowing foreign investors to come to India. The capital market in India consists of two kinds: primary market, secondary market. First, primary market. It is the market in which a company directly sells the shares to investors or public. It enables company to raise funds from the general public through the issue of sale of shares. The primary market, also called the new issue market, is of vital importance to the economy of a country, as it leads to better utilization of otherwise inactive or dormant savings in the economy. The sale of shares is made at a value predetermined by the firm issuing the security. The price at which the security is sold to the public is the offer price or the issue price. The issue price could be equal to or greater or lesser than the face value. Say for example, if issue price is more than face value, the shares are said to sold at a premium. If issue price is less than face value, the shares are said to sold at a discount. And finally, if issue price is equal to face value, the shares are said to sold at par value. The shares which are issued in primary market have a face value. The face value represents the denomination of the shares. For example, face value of 1, 5, 10 or 100. The role of the primary market is to mobilize and sustain capital funds in the economy in the long run. For this to happen, it is important that incentives be maintained in the right way. The maximum incentive must be for the long run, somewhat less for the short run, and the least in the immediate context, which is post-listing. Methods of raising finance in primary market. There are many ways in which a company may raise capital in the primary market. Number 1, public issue. When an issue or offer for securities is given to new investors for being a part of shareholders' family of the issuer is called a public issue. Eligibility norms for public issue. A company is said to be unlisted company if it can make an initial public offering of equity shares or any other security which may be converted into or exchanged with equity shares at a later date, only if it meets all the following conditions. Company having net tangible assets of rupees 3 crores. It should be preceding 3 full years of 12 months each, of which not more than 50% is held in monetary assets. Point B. The company is having a record of distribution profits in terms of section 205 of the Companies Act 1956 for at least 3 out of immediately preceding 5 years. C. The company has a net worth of at least rupees 1 crore in each of the preceding 3 full years of 12 months each. D point, the aggregate of the proposed issue and all previous issued made in the same financial year in terms of size does not exceed 5 times its pre-issue net worth as per the audited balance sheet of the last financial year. The last point, if the company has changed its name in the past 1 year, 50% of the revenue for the past full year is earned by the company from the activity suggested by the new issue. Point number 2. Public issue can be further classified into 2 types. Initial public offering, commonly known as IPO. The most important mode of issuing securities is by issuing prospectus to the public. If the issue has been made for the first time by a body corporate, it is known as initial public offer. The securities which the companies issue for the first time, either after incorporation or on conversion from private to public, are called initial public issues or initial public offerings. Further public offering, FPO, or season public offering, SPO. When an already listed company makes either a fresh issue of securities to the public or an offer for sale to the public, it is called a FPO. Private placement. When an issuer makes an issue of securities to a select group of persons not exceeding 49 and which is neither a right issue nor a public issue, it is called a private placement. There is one more type of placement known as qualified institutional placement. We shall now discuss the pricing methods of initial public offering. The initial public offer can be priced on the basis of 2 methods. Fixed price, where the price is before the allocation. Book building is a process where an indicative range is given prior. Offer price and quantum is fixed on the basis of the bids. The vital methods of evaluating capital assets are as follows: fixed prices, which is based on a formula, and book building approach, which consists of price banding. The price of an IPO can be studied by taking 2 regimes separately, that is pre-liberalization, the controller of capital issue CCI era before 1991, and post-liberalization, Securities and Exchange Board of India, commonly known as SEBI era 1992 onwards. CCI era. In the times pre-liberalization period, pricing of IPO was done with the help of CCI formula. The firms took approval from the Office of CCI Capital Issue Control Act 1947 for raising capital, and the CCI used to fix the size and price of the IPO. The reason behind the philosophy was to ensure that there is no concentration of economic power. SEBI era. The Narsimham Committee in 1991 initiated a reform process in capital market where it abolished all types of controls and restrictions. It introduced the elements of transparency, freedom and disclosure, which are based on a well-designed regulatory framework. The first big step of liberalization was the repeal of Capital Issue Control Act 1947 in May 1992, and SEBI was formed. SEBI has made many reforms, and a very important reforms were in the form of new mechanism. This, named as book building, was recognized as a method of pricing by Securities and Exchange Board of India on the recommendation of the committee under the chairmanship of Y. M. Milligan in 1995. The primary market saw a boom. It was in terms of numbers as well as the issues as compared to CCI mechanism. The above two periods can be studied keeping in mind the different pricing methods. Number 1, fixed price method, and number 2 is book building method. First, the fixed price method. It is an age-old method of pricing the IPO. In this case, the issuer and the merchant banker agree on the price of the issue before making the actual issue, and the investors are required to fill in an application form at this price and subscribe to the issue. Book building method. This is basically a price and demand discovery method. According to SEBI, the book building is a process undertaken by which demand for the securities proposed to be issued by a body corporate is decided and built up, and the price for such security is assessed for the determination of the quantum of such securities to be issued by means of a notice, circular, advertisement, document, or information memorandum or offer document. Book building options. The issue of securities through book building can be done in either of the following two ways: 75% book building or 100% book building. In the 75% book building, the issue can be categorized into the placement portion. The placement portion is the portion of the issue offered to the public through the syndicate by the way of book building process, and the public portion. It refers to the offer to the public. By and large, it is responded to by retail offering. The price arrived at in book building method is applicable to the public offer. Now we will understand the book building process and overall IPO process in the form of a diagram. Firstly, the company plans an IPO by the book building route. Plans an IPO means company need funds for its expansion, for diversification. Company needs money, and one point which should be noted here is that company has exhausted its loan taking capacity from the bank or financial institution. So the only option left for the company for raising money is an IPO. Once the company decides that company is going to raise money through an IPO, and that too from a book building route, company appoints a merchant banker as book runner. Merchant banker issues a draft prospectus containing all mandatory company disclosures, and all those mandatory disclosures are mentioned in SEBI guidelines. Draft prospectus filed simultaneously with the concerned authorities, that is SEBI. Book runner appoints syndicates members and register intermediaries to garner subscription, and after that price discovery begins through the bidding process. And lastly, at the close of bidding, book runner and company decides upon the allocation and allotment. One point which needs mention over here, that SEBI does not play any role in deciding upon the cutoff price of any issue. It purely depends upon the company and the merchant banker, who in consultation with each other decides the final cutoff price within the price band which they have offered or mentioned in the prospectus. After having discussed this, the IPO investors. In the book building process, three classes of investors can bid for the shares: retail individual investors, high net worth individual investors, and qualified institutional buyers. Firstly, the retail individual investors. In this category, investors are not allowed to apply more than rupees 2 lakhs in a particular initial public offering. They have an allocation of 35% of shares of the total issue size in book. NRIs who apply with less than rupees 2 lakhs fall into this category. They can put bids for more than rupees 2 lakhs in initial public offering. They can do so applying in non-institutional investors category, as there are no upper limit for bidding in non-institutional investors category. Next, high net worth individuals. This category consists of individual investors, NRIs, companies, trust, partnership firms, etc., who bid for more than rupees 2 lakhs and known as high net worth individuals. High net worth individuals have an allocation of 15% of shares of the total issue size in book build IPO. Here one point need to be mentioned, that before 2009, the PAN is not the required statement for retail individual investors to apply in an IPO, whereas PAN number is a mandatory disclosure requirement for high net worth individuals. But after 2009, both retail individual investors and high net worth individual investors, both of them have to disclose their PAN number in the application form under which they are applying. The third category is the qualified institutional buyers. This category includes financial institutions, banks, FIIs and mutual funds which are registered with SEBI. These people apply in very high amounts. They are majorly representative of small investors who invest by mutual funds and ULIP schemes of insurance companies and pension schemes. They have an allocation of 50% of shares of the total issue size in book build IPO. In earlier times, they were required to pay only 10% of the total value of the shares at the time of application. It has changed from May 1, 2010. The SEBI has asked QIBs to pay 100% of the value of shares. It is valid in all new issues at the time of application for IPO. The new role for QIB was aimed at bringing them on a par with retail investors who always paid 100% of the money while applying for shares. Here one point need particular attention. When QIBs are making only 10% of the payment of the amount which they have applied for, understand that what it leads to the overall increase in the subscription, or the subscription is increasing to its multiple times. SEBI has objection to this, and SEBI has said that the QIB now have to pay 100% of the total value of shares which they are applying for. The next in line is IPO grading. One of such important development in the IPO market in India took place in 2007 when SEBI introduced the concept of grading of IPOs and made it mandatory from May 1, 2007. SEBI initiated the concept of grading equity issue in order to safeguard the investors' interest. One of the reasons for introducing IPO grading is to prevent the fly-by-night promoters. IPO grading was done as a service in the form of independent assessment of fundamentals of the new companies by credit rating agencies registered with SEBI under the SEBI Credit Rating Agencies Regulations 1999. Concept of IPO grading. According to SEBI, IPO grading is a service aimed at facilitating the assessment of equity issues offered to public. IPO grading is a one-time process done prior to the opening of the issue during the draft prospectus stage. IPO grading is a 5-point scale, and the grade given to an IPO shows the assessment of fundamentals of graded issues relative to other listed issues. IPO grading is just an independent assessment of fundamentals of the company to help investors to make decisions. However, IPO grading is not a substitute for investor judgment, and it is not a buy or sell recommendation. The Indian stock market regulator SEBI is the first in the world to make IPO grading mandatory for all the unlisted companies. IPO grading scale. IPO grading involves in-depth assessment of various qualitative and quantitative parameters of the issue. According to SEBI, IPO fundamentals would be graded on a 5-point scale form. Grade 5 indicating strong fundamentals to grade 1 indicating poor fundamentals. The assigned grade is a one-time assessment done prior to IPO at draft stage. This will be beneficial for investors for investing in IPO. IPO fundamentals are graded on a scale of 5, grade 5 to grade 1 as given below. Number 1, IPO grade 1 means strong fundamentals both financially and as well as the risk factor is concerned, that is also low. IPO grade 4 above average fundamentals, IPO grade 3 average fundamentals, IPO grade 2 below average fundamentals, and IPO grade 1 poor fundamentals. We shall now recapture what we have learned so far. Primary market is the market in which a company directly sells the shares to investors or public. Primary market is a market where there are no geographical boundaries. As against the secondary market, it has geographical boundaries like stock exchange. When the shares are issued for the first time, it adds to the total paid up capital of the company. And once these shares are issued through an IPO route, after that the buying and selling of shares takes place in the secondary market. The buying and selling of shares in the secondary market does not add to the paid up share capital of the company. Next, we have learned method of raising finance in primary market. Public issue. It is made when an issue offer of securities is given to new investors to become part of shareholders family of the issuer is called the public issue. Private placement. This type of finance is raised when an issuer makes an issue to a selected group of people. They should not exceed 45 in numbers, and it is called a private placement. This issue is neither right issue nor a public issue. Public issue can be further classified into two types. Initial public offering. The most important mode of issuing securities is by issuing prospectus to the public. If the issue has been made for the first time by a body corporate, it is known as initial public offer. In this, the companies issue securities for the first time. It is done after incorporation or is done on conversion from private to public. Further public offering. This type of offering is made when a company which is already listed makes a fresh issue or an offer for sale to the public. It is called a FPO. Initial public offer can be priced on the basis of two methods. Fixed price, where the price is set prior to the allocation. Book building, where an indicative range, the so-called price range, is given beforehand, and an offer price and quantum to be issued is decided on the basis of bids received. Book building process or the auction process is again of two types. multiple price auction or uniform price auction. Under uniform price auction there is a single cutoff price, and in multiple price auction there are multiple cutoff price. One phase which fits very well under multiple price auction is the winner's curse. In India, Coal India Limited is the first company which has come out with an IPO with multiple price auction. Otherwise, 90 to 95% of the book building is done through uniform price auction system. IPO investor. In the book building process, three classes of investor can bid for the shares. Retail individual investors. In this category, investors are not allowed to apply more than rupees 2 lakhs in particular initial public offering. They have an allocation of 35% of shares or the total issue size in book. NRIs who apply with less than rupees 2 lakhs fall into this category. They can put bids for more than rupees 2 lakhs in initial public offering. They can do so applying in non-institutional investors category, as there are no upper limits for bidding in non-institutional investors category. High net worth individuals. This category consists of individual investors, NRI companies, trusts, etc., who bid for more than rupees 2 lakh are known as high net worth individuals. High net worth individuals have an allocation of 15% of shares of the total issue size in book build IPOs. Qualified institutional buyers. This category includes financial institutions, banks, FIIs and mutual funds which are registered with SEBI. These people apply in very high amounts. They are majorly representative of small investors who invest by mutual fund and ULIP schemes of insurance companies and pension schemes. They have an allocation of 50% of shares of the total issue size in book build IPO. In earlier times, they were required to pay only 10% of the total value of the shares at the time of application. It has changed from May 1, 2010. The SEBI has asked QIB to pay 100% of the value of shares. It is valid in all new issue at the time of application for IPO. The new rule for QIB was aimed at bringing them at par with retail investors who always paid 100% of the money while applying for these shares. IPO grading. According to SEBI, IPO grading is a service aimed at facilitating the assessment of equity issues offered to public. IPO grading is a one-time process done prior to the opening of the issue during the draft prospectus stage.